Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk about strategy, my strategy. We have the community, we do a lot of question and answer sessions, and this is some feedback from one of the members that posted this on the Discord, and I'd like to share it with everyone and the strategy of the community, I should say, or my strategy, the strategy of the YouTube channel that I've got. We'll go over that strategy and kind of refresh everyone on it and why maybe I adopted that strategy. I took bits and pieces from all the best investors. Then I looked at the markets from the data backwards, and then I found similarities. I won't go over all the similarities. I won't go over the thesis and the real estate cycle and all that stuff, but I will talk strategy in this one. And hopefully it clicks for some people of how I look at the markets, the paradigm in which I view the markets. There's a lot of value here that I've basically figured out. Probably took me at least a decade to figure this out. So let's go through it. I'll read some statements, questions, and then I'll kind of come back and answer a lot of this stuff. So she said, I wanted to mention, I think your platinum sessions are so worthwhile. Some of the concepts, charts, etc. were so foreign to me at first, and I had to hear them repeated. For example, I couldn't figure out how you would ever make money holding stocks for like 2 years. Once you understand the basics of your strategy, you start to see that you can't make real money unless you buy at the right time and then sit in them for a good long stretch. On the Q&A sessions, you might want to mention that for the next 20 minutes, I want to take questions from new members only or from people with questions about something basic. For a long while, I didn't understand the basics of your strategy. And because of that, I didn't understand some of the conversation. I think it would help a lot of people. One QA session, you mentioned that you were up 3 times in SM Energy. Someone asked you why you didn't sell it quick. You were like, why and buy what? And leave money on the table when it runs more? That was a light bulb moment for me. Then you quickly reviewed what factors made you buy the stock, reviewed whether those market conditions are still same or reversing. Where you are in the life cycle of the chart, I was shocked. I realized that I was searching for stocks, any stock that would double, buy them, sell them for 100% gain, search for others. I can't be the only person out here who is learning these basics for the first time. Well, they're not basics. You actually learned, I would say, advanced methods. So I'm going to come back in here. I've got Northern Oil and Gas in the background. So the strategy. What is the strategy? How does it work? Why is it so good? What are some things as an investor you have to change in order to adopt this strategy? Okay, so on the website, in the YouTube channel, I call it a 3-pillar approach. And that's my strategies. It's these 3 basic pillars: market conditions, ratios, and the technical analysis to have an unbiased opinion of maybe where we're at. It's basically gauging human behavior. Now, all 3 of these are intertwined together. None of them are separate by themselves. So, for instance, in order to ensure that we have the right market conditions, I use technical analysis. And in order to see if something's bottomed and reversing higher in the ratios, I use technical analysis. Technical analysis is what you're basically looking at is you're looking at money flows in the market. And the way that you price assets and knowing which assets perform under certain market conditions is what allows me to figure out where we're at in the cycle. This cycle, which is driven by the demographics, is just money flowing back and forth between assets. And like I've said before, we are front-running the money flow. We're front-running the money flows coming into that asset. But that's all we're doing. And money goes back and forth based off of inflation and the movement of interest rates. And it takes time. It takes a long time. I know a lot of people think that these cycles, you have to match your time frame to the time frame of these cycles. This cycle, it's an 18.6 year cycle. That's the real estate cycle. That's generally from, we'll say, bottom to bottom, an 18.6 year cycle. And this portion of the cycle, let me step back. The recovery phase of the real estate cycle that we just went through, it was about 9-10 years. And you could even argue it was a little bit longer than that, maybe 11 years. And the expansionary phase, I think, is going to take time for us to catch up. And it could be shorter, could be 5 years or something like that, where it'd be 11 plus 5, which is only 16 and a half. Or it could be a lot longer, and we could go another 11 years, which would be a 22-year cycle. The average is 18.6, but we have a larger deficit than a lot of those other cycles. And we spent a longer time in the recovery phase. And I have a feeling we're going to spend a longer time in the expansionary phase. Each of those phases that we go through, certain assets are preferred. So in a recovery phase, assets are preferred, and certain assets are preferred in a recovery phase. That's mainly technology stocks. It's mainly the S&P 500 and other stocks like Visa, MasterCard, whatever it is. Then you go into an expansionary phase, interest rates start to kick up. We saw that interest rate kick up in 2020 to 2022. That's part of that phase. That is signaling that we're in the expansionary phase of real estate. And it's quite heated. Why interest rates have moved up so much in such a short period of time. Inflation is what caused that move. Under those market conditions, commodities do well. And then on the back half, just behind this, gold and silver is going to do crazy things. It's all intermixed. Technology stocks will not. So the cycle length, the time frame, you have to match your time frame and your expectations to the cycle length. That's like utterly important. So when I view these things, the investments, I view them from the cycle length. The cycle length here of an expansionary phase, which might have started in 2020, might be 8 or 10 years. So 2028, 2029, 2027, it's somewhere in that range. We're too far away from the end to really gauge where that end will necessarily be. We're just too far away. And the way that I view some of this stuff is you need to know what the important leading data and factors are. A lot of people, they look at all this data, but half of it's not important. They're all tertiary effects of main drivers. Main driver is the demographic. And then you can look at the real estate housing starts. Housing starts is a leading indicator, and it's interacting with that demographic back and forth. That's basically your first leading indicator point. Then you keep going backwards. What are the inventory levels? Inventory level and housing starts, they work hand in hand. And almost always, commodity bull markets have ended when the real estate cycle had a bunch of inventory. So what is causing this rotation of money is interest rates, inflation and interest rates. So that is what's causing the rotation. Demographic is the leading factor of it all. And then money moves different under those conditions. So the time frame is ultimate. It's like the ultimate there. Now, during these cycles in commodities, commodities are very volatile. They can do incredible things in very short periods of time. You have to be very patient with commodities. They're very volatile. The price movements go up and down a lot. But that's also what is going to give you the upward thrust to the upside. 100%, that's nothing. That is absolutely nothing. You can get that move in a little baby move off the bottom of a accumulation phase. The big moves can be 20, 30, 40 times your money. You're going to have to be good to capture those moves. You're not going to be a rookie investor. It's just, you're not going to know what the heck's going on. You have to tie all of this together emotionally, logically, and then like figure out a strategy that's going to work. So the strategy is I just described some of the market conditions. We want the demographic interacting with the housing market and expansionary phase for commodities to do well. That is a market condition. The other market condition is a recovery phase, and then the other market condition is a hypersupply phase where we go into recession. There's 4 phases. Each of these phases has differing investment asset classes. And the commodities is where we're entering right now. This is a commodity boom in the expansionary phase of real estate. We'll go into some hypersupply phase when we get a bunch of inventory. At that time, we want to swap over to long duration bonds. Then, after that market crashes, we're in bonds. Bonds go way up, and they can go up a lot, guys. They can go up during a crash, especially if you're at very high interest rates. If you're at a 10% interest rate and the stock market really crashes and bombs out, you can make a lot of money if interest rates really dive down. So, and it's a very, very large asymmetric bet, very large. And we're going to play it. Don't worry, we're going to play it. We're all going to play this together. So that's the bond. And then when we get to the bottom and it starts coming up, that's when you would buy your homes. You buy your homes, your vacation home, your third house, I don't know, whatever it is. And then stocks like technology stocks, they're going to rip. They're absolutely going to rip. Just like it was in 2011, 2009, 2010, 2011, you could be buying them all through there. And then you ride it all the way up till 2020 or so, 2020, 2021. So we're in this commodity phase. You got to get your time frame right. Your time frame should be looked at by a decade or so, 2020 to 2030. Think of it like that. Then we use our technical analysis and our ratios. Our ratios will tell us with certainty where the money is and where the money is not. We looked at 2020, and I'll pull one up here real quick for you guys. Well, here's a ratio right. Oh, it must be this one. I must have deleted my ratio right here. 1 second, guys. Well, here's a ratio. I'll just go over a ratio. This is XEU. This is gold and silver mining companies to gold. And we're at a very, very low ratio down here. This is like an anomaly low. All right? What this is telling us is that money is not in XAU. So money's not in XAU. It's not in the gold and silver mining companies. That's what XAU represents. And gold, if you were to price gold against other sectors, like let me pull down here real quick, like a gold to Dow Jones to gold ratio. Here's one. This is Dow Jones to gold ratio. We've got our movements up and down. I think this is going to break to the downside and go lower based off of a bunch of various metrics that I watch, like interest rates. Interest rates breaking that 40-year downtrend line to the upside is going to push gold higher and Dow Jones Industrial lower, is my guess at least. So if Dow Jones is expensive to gold and gold and silver mining companies are cheap to gold, then gold and silver mining companies are just ultra cheap. And that we can know that with certainty that is cheap using these ratios compared to history. So what I'm doing is I'm accumulating a bunch of undervalued cheap assets. And when the market conditions ripen up for it, which I think we are, all that money that is in other assets will rotate into commodities and precious metals. But it takes time. This isn't overnight. It is not overnight. It may take a decade for that whole rotation to happen. It'll come rotating over in 2020. It's already done that. We can see these large moves off the bottom for a lot of companies. And all that rotation's kind of come over. And I've been riding it since 2020. I haven't sold anything. And I know a lot of people wanted me to sell. And it's like, no, I'm not going to sell. I'm going to ride the cycle. The cycle is driven by the demographic. It's driven by inflation. It's driven by all these things. It's just the market trying to seek a balance. If we have a deficit or we have underproduced something, the market's going to take time and it's going to have to figure out how to balance the market. And Since a lot of these markets take a long time to cycle, like basically bring more supply on, the cycle is going to last a long time. And prices are going to go a lot higher to price out demand and price on supply. The ultimate factors of how high and how low the price goes in commodities is dependent on supply and demand, and it's also dependent on the cost curve. That is ultimately uh, where the price bounces between. We can see large anomalies in prices during very fearful events, where you get a large sell-off to the downside. The ratio blows out, very favorable for certain commodities. Oil in 2020 went negative, which means the ratio went ballistic. That's called the best opportunity of a lifetime. That's what that is. And then I panic buy. I buy when everyone else panics. Called panic buying. I do that because I know how to value the assets using ratios. I knew that the market conditions were ripening for this rotation to occur, and I use technical analysis to validate that it's all happening by using bottoming patterns, by using continuation patterns, all these things that I use. And then the ratios tell you that it's cheap without any sort of opinion. It's just a fact. It is cheap, period. Then the question is, well, when is it going to rotate it and turn? That's when you use your technical analysis. So what I'm doing is I'm combining all of these strategies. So I'm focusing on what's cheap. I'm accumulating all the cheap assets. I'm looking at the market conditions saying, yep, the demographic's going to push this inflationary move. So my strategy isn't 100%. My strategy is to play the commodity sector as long as the tailwinds are behind it. So if the winds are constantly behind you, and commodities are going to do well, well, then why would I go anywhere else? Where else am I going to go? Because the tailwinds are all commodity, 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 and that might last for 10 years. And if the deficits still remain, problems haven't been solved. So it's a combination of supply and combination of credit. Credit is the demand. And the credit in an expansionary phase is what's coming and driving that demand. It's the credit expansion. It is it's the underperformance of the other sectors as well, which is going to cause selling pressure. So bonds are underperforming. It's going to cause selling pressure. The stock market's going to underperform, in my opinion, and it's going to cause selling pressure. And that money's going to rotate, and it's going to chase performance in the assets that we're in on the website and on the channel here. They're going to go after energy service. They're going to go after oil and gas. They're going to go after uranium. They're going to go after all these different things. And we can see in the charts that we've got these big accumulation cylinders on like the majority of them. We've got inverted head and shoulders. We've got all the patterns that we want to see. They're across the board everywhere. The evidence on the other side is they're putting in topping patterns or have topped, like bonds have already topped and going down. Those patterns are all in place too. So this market is all interconnected, guys. There is no this market is separate from this market. They're all interconnected like this. The interconnected nature is the money that just breathes and lives and flows around everything. When humans interact, they are emotionally, they have these emotional responses to their portfolios. If you're getting killed in a certain sector, you're more likely to sell it. If you're seeing something else go up, you're more likely to participate and chase those returns. So a strategy that we try to do, is we try to find an alignment. We try to find an alignment between a changing market condition from one market condition to another, which we have. Then we want to look for ratios that are changing too, that have bottomed out, broken down trend lines, putting in bottoming patterns and starting to move on up. And we're going to buy the pattern. We're not chasing price. So patterns and the relative cheapness compared to history is what we purchase. And then you have to be ultra patient. Ultra patient meaning These may take a year or 2 or 3 or 4 to bottom out and really start to gain traction. The beginning and end of these cycles take time. So a cycle may take a topping pattern for 5 years and a bottoming pattern for 5, 6, 7 years before it really starts to take off and the momentum gets generated. The slow movements can still net a lot of money and gains. And then the middle to end, we get a gigantic move. That's when the gains really start to pile on very quickly. That is when money's rotating and the retail sector chases it. And that's when you got to get out. So the strategy here, from like a big picture view, strategy wise, is you look for bottoming patterns. You make sure the ratios are cheap. Make sure the market conditions are favorable for the assets that you want to buy. You basically have all tailwinds behind you. You have a long runway for asset appreciation for the ratio to move and change. And I'll just give you an example of what that looks like here, because I've just got the platinum to gold ratio. This is exactly what I mean. This was a peak in the platinum to gold ratio where platinum was expensive. You want to buy gold. You ride it all the way down, and then you want to swap your gold back to platinum at the bottom here if you had a bunch of gold. And now we're putting in we broke the downtrend line, and we're putting in a slow bottoming pattern, and eventually this is going to go higher, in my opinion. The market conditions under a commodity bull market do very well for platinum to outperform. Gold can go up too. I'm not saying that gold can't go up. What I'm saying is platinum will probably outperform gold, even though they're both going up together. And that's the basics of ratio investing, and that's the time frames. You have to stretch those time frames out. This is how you make a lot of money, like life, earth-shattering money. You're not playing a 100% move. You're not playing a 200% move. You know how to value the assets. You know what's cheap. You know how to identify what's cheap. You know when it's expensive, and you know how to identify market tops to get out. And you can play the entire valuation movement. Another thing I look at is what's called fractals. A fractal is a repeating pattern that occurs over time. Humans trading with each other create these patterns, and these patterns are repeated over and over and over and over. And what you can tell with some of these patterns is the potential returns based off of the pattern that it creates, quote, the fractal. And when we look at the fractal, we can see the size of it. And generally speaking, the larger the size of the fractal, and what we call it in Elliott waves, you get 3 waves. It's a first wave, second wave, third wave, fourth wave, and then a 5th wave top. The first wave, depending on how big that wave is, you can somewhat determine, not always, but most of the time, it'll determine how big the third wave is, which is the largest wave, the third wave is. And I'm using these waves to figure out where to put money. So that's one of the deciding factors on where and how I allocate money to what company. Now, the companies, you have to really be careful on how you select companies. When you set up a portfolio, I think a lot of retail investors, the mistake that they make is they want to go full risk. That is not the smartest strategy, in my opinion. I think that strategy could very well backfire on them. So I look at these fractals. They can determine how big the third wave can be, and I load up. I mean, that's kind of the basics. And finding these companies, looking at the fractals, you can look at the balance sheets, you can do the fundamental analysis. The fundamental analysis won't get you where you need to be. You need to know what the people are putting money into. You need to know where people are accumulating and creating those patterns. There are companies that are high-cost producers. There's a bunch. And you need to know where people are preferring to put their money, and that's where I'm going to put my money, is where they prefer and create that fractal, that big first wave and second wave. It's not going to be perfect. There's going to be some laggards that you might miss. There might be some other companies that could do incredible stuff that are small caps that don't respond in the first wave because they're just such high-cost producers. There is some of that, obviously. So what I do is I look at risk-reward for the companies. Risk-reward is how much risk am I taking on and what is the potential reward that I'm getting for the risk that I'm taking on. what you'll generally find is that there's a sweet spot. And the sweet spot is where you get like a smaller cap company, small to mid cap company that got decimated on the way down during a recession. You buy it at the bottom when things are just blown out. They're absolutely blown out. There is risk there, and some of these companies, because if they've got some debt, they really are volatile. And if people get scared, where they think they could go bankrupt or something like that, then they just push them to pennies on the dollar. That's your opportunity. Your opportunity is when they push them to pennies on the dollar. And what you're going to see when you look at some of this stuff, you're going to see an alignment. You're going to see an alignment where you pull up like crude oil versus gold, right? See how this thing blew out to the downside? That's your opportunity. What that's called is a false breakout. So if you were tracking this crude oil to gold ratio and you saw this thing blow out, your opportunity to load up was in 2020. But also, there's a lot of risk there. There's a lot of risk because some of the companies did go bankrupt. But that's where you get your pennies on the dollar. That's where you get your 20, 30, 40, 50 backers. It was off that bottom. So you have to be able to identify that. And that's what I do, is I identify that stuff. This here is your first wave. It's right here, first wave. And then here's your second wave. And I think we're going to get up into a third wave here where we go up massively. That's what I think, at least. So this is positioned absolutely. This is a gorgeous chart for crude oil against gold. This is saying that we want to be in crude oil on this right-hand side here, is what it's telling us. And there's obviously a bunch of other charts, but crude oil is looking fantastic. And that ratio and technical analysis are telling me that. It's also telling me something about the market conditions by looking at that chart and how crude oil is outperforming gold. If you look at history, you can see that certain assets outperform during certain periods. What we saw were two different charts there. We saw the platinum to gold ratio that was about to outperform for platinum, and the crude oil to gold ratio, which looks like crude oil is about to outperform. What crude oil and platinum, if you were to look at history, are very sensitive to inflation. So I think that we're going to an inflationary period based off of these two charts, just these couple of different, these three assets charted against each other. And that's what drives my decisions. That's it. I don't need news. You can throw news out the door. I don't need to listen to anything. I look at inventory numbers of real estate. I look at housing starts. I look at the home builder stocks, see how they're doing. And then I look at all these different ratios to see what the markets think about the future. And then they tell me what they think, if you can decipher it. And I decipher it using technical analysis and all the ratios. Then I look at how to position. And positioning is absolutely important. Where people mess up, and I'll get back to that, people mess up by taking on far too much risk. You're not getting the juice isn't worth the squeeze to up the risk as far as they're going. So there's a lot of small mid-cap companies that are really good that can give you all the juice that you need for the squeeze, and you don't take all the risk in the world. There's going to be a risky period, which is generally in the beginning, and then when the cash flows go up because the commodity price goes up, everything changes for the company then, and then it becomes a cash flow machine. And what you're doing is you're looking and evaluating companies not for their current balance sheet. You're investing in companies based off of the commodity price movement and the future balance sheet that they'll have. And that's how you basically want to do it. A lot of people say, well, I'm going to look at the balance sheet. The balance sheet's horrible. It looks absolutely horrible. It's like, yeah, you're buying at a bottom. I mean, that's what they do at the bottom. What you're buying is not this current balance sheet. You're buying the future one, where if the commodity goes up 10x, they're going to be making so much money, you're going to be laughing. So the strategy is use the ratios, find the bottoms, and then buy the crap out of companies when they're cheap. And you can also price the company against the commodity as well and find out where they're bottoming. Just to give you guys an example of what I mean, here's SM Energy divided by natural gas. And you can see the bottom where I bought it was in September, October of 2020 is where I bought this. Right at the bottom there where that orange circle is. This is a falling wedge. I bought it right at the bottom, and I've been riding it all the way up. And I do think that this is going to go all the way to the top here somewhere at some point. And it's been outperforming natural gas. And I think natural gas is going to do some crazy stuff, and SM is just going to go up faster than natural gas. That's what that is signaling. So we're in a bull market for SM Energy versus natural gas. And SM Energy is one of the companies I bought at a very good price, very good entry point. Still own it. I did sell a teeny bit to go into and diversify into some precious metal stuff. But yeah, that's absolutely excellent entry point. And that SM to natural gas entry point was like that against all of them. All of the companies that I was looking at the bottom there. They all possessed it. What's the chance that that was going to fail? They all had falling wedges, guys. Pretty good entry point. Everything was in full alignment. Oil and nat gas were super cheap. It was perfect entry point, and that's where I went big. Uranium was really good at that time too. So that's what I'm doing. I'm identifying all this stuff. I didn't read this in a book. I didn't learn this from anyone. I just taught it myself. I taught myself how to do all this. Figured it out, thought it out, just thought out, how would I go about buying this stuff? And this was the only thing that made sense to me. So no one taught me this. And what I'm doing is I'm just showing everyone else what I did on the website. And then I show you guys picks. I show you tons of picks. Some of them are turning out to be very good. And we have some laggards. We do. And some of the small, high-risk stuff is still sitting there. Some of them. And then the sweet spot ones, they've absolutely smoked it. Absolutely smoked it. We got some big dividend paying ones as well. So that's kind of my strategy. That's how I've been looking at this whole thing. I'm sure everyone's kind of pieced this together if you've been on the channel the entire time. And that's how I'm doing it. Basically, all that stuff right there. But if you guys like this content, give me a thumbs up. Subscribe to the channel. Subscribe to the website. We do have a discount going on, 50% discount on the monthly membership. It's September, all lowercase. And I'll go over a bunch of different companies with you guys. I can tell you, what's risky, what I would do, what I'm buying. You can see what I'm buying. I have a post that I naturally update in the top section. It goes to the top, and you can just click on it and see what I'm buying and the pricing that I'm buying it at. So I put it that day. The day I buy it, I do it after market close. I consolidate what I purchase, and I put it up there. I don't purchase a lot. It's like a few companies every time I purchase, and I purchase every couple days or weeks or whatever. And you can see exactly what I'm buying, the price I'm buying it at, and I don't ever change it. I haven't really sold anything. I just keep buying and accumulating. And I'm waiting for this commodity bull market to play out to its entirety. So that's my strategy, guys. That's what I'm doing. And now you know kind of what I'm about. It's a longer term investment. It's not short term stuff. So that's what I've got. We've got the question and answer session that's in session right now. It started at 7 a.m. On Saturday today. And I'll let you guys be. Have a good weekend. And we'll catch you later. This is Finding Value.